Hello everybody, this is Mr. Lu. I have a very interesting topic that I want to share with you today. It's a rather gloomy topic. So I met up with my fund manager, hedge fund manager, a few days ago for my birthday lunch with him. And he's a brilliant fund manager, grew his fund size and his wealth tremendously from almost nothing to, today he has a family office, very well-to-do gentleman, and he's very, very bright, right? So I asked him about the performance of the funds and when the fund is gonna have a rebound, and his answer was very interesting. He says the fund will rebound strongly when the economy snaps, right? When the economy breaks. Now that's a very profound comment that he made, right? So he's waiting for the economy to break. And I asked him what's the likelihood of that happening. He says, very, very high, with almost certainty. Well, I was like taken aback by his observation, right? So let's discuss about this observation that he has and his opinion. Now, right now, as we look at the global landscape, the outlook is actually quite risky. Okay, quite risky. The war in the Middle East between Israel and Hamas right now has already expanded to the north with Lebanon, Hezbollah, okay, and potentially a lot of countries surrounding Israel are all protesting in a big and mega way. So today, President Biden has arrived in Israel to show support to Israel, but my guess is that a very soft and hidden agenda is to tell Israel, don't overdo it. Israel has lined up, 360,000 reservists and a lot of tanks and artillery right now with all our airstrikes going after it. But they have not invaded. Why are they waiting so long, right? I've learned that the longer you wait for a strike, the enemy has more time to prepare. So the reason probably is because there's a lot of pressure telling Israel not to overdo it. But Israel has so far died 1,000 over people. This blood is not going to go unpunished, right? So I think that this war has a very high risk of escalating and engulfing more countries drawing into it. So if a war breaks out in the whole of Middle East or in a big way, then it will be like 1973 altogether. The oil prices will shoot up. And the oil prices shoots up is going to break the global economy for sure. So this is one of the big risks that we have, okay? So this war, if it happens, will have an implication as bad, if not worse, than the Ukraine-Russian war. And now it's probably a good segue to look at the Russian-Ukraine war. There are no winners in this war, right? Ukraine, because they waited for one winter before they strike again, now has seen the Russian well fortified. Russia has gone from a protective stance to now counter-attacking. So it is going to and forth. There are no clear winners. Russia cannot win, Ukraine cannot win, and there's a stalemate, and there are no good outcomes to this. And I think, this war will, because there is no good outcome to it, we will not see the upsides of it, and we are all experiencing the downside of it already. As for the Chinese economy right now, it is looking still bad. The economy slumbers is still going on. I've talked about the dipstick field I have from looking at the Chinese tourists, but the downturn is still there. The problem is not going to go away for a long time. Now, I don't know when the Chinese economy is going to go away, but there is a chance, there is a strong chance that the Chinese economic slump is going to go on for quite some time, and it may even worsen. So if you look at all these circumstances, there is a chance that the economy, the global economy, will break. Okay, will break. And what do we mean by break, right? We are thinking about a recession. Okay, a recession. Of what size is hard to say, but a recession. Let's talk about what are the possibilities, right? Possibilities. Now, we're not saying that it will. We're just saying that chances are, it could happen. It could happen, right? So we're doing scenario planning right now. So let me say again, do not say that Mr. Lu say that economy will break, okay? I'm doing a scenario planning just in case it does. Now, when it does, what should we do? That's basically what this talk is all about. So the first in the three scenarios I painted, it's actually quite easy to predict the outcome. So if those scenarios come out in a bad way, then recession will surely hit, right? Now, as Singapore, Malaysia, and Asia, there's a good chance we'll be hit pretty badly. Export-oriented economy, investment-driven economy like Singapore will be hit pretty badly. Then all the 1997, 2008 situation will happen all over again. In those situations, one of the first few things that will be hit, it will be, of course, Singapore stocks. Singapore stocks will be hit. Singapore property has never escaped being hit by a recession. So if the recession hits hard, then the property will hit hard. And this time around, it will hit hard because we have a glut of a lot of supply right now. The excess supply that we're building up right now is to, not excess, the high level supply right now that we're building is to fulfill the high demand that's built up, right? But what if the high demand vaporizes because of economic downturn, right? So that scenario will be bad for property prices. Already our property sectors is slowing down. I'm not saying it's crashed, okay? Before the property critics point out Mr. Lu again, I'm saying that the economy, the property sector has slowed down. But right now, if the economy breaks, then we will see a hard hit on the property sector. Of course, if you hold for 10, 20, 30 years, the property sector will eventually recover, right? How many of us can wait so long? That's a good question. Well, fortunately, the scenario forward is that as the job market get hit, the government generally quickly swing into what I call a job saving mode. What they do is they use job credit schemes and help to save companies help to save workers from being retrenched. But this will not protect workers from pay cuts and pay freezes. So the government actually encourages pay freezes and pay cut as compared to job cuts. So this would of course hit the general economy. Stocks will be hit as well. Property mortgages will probably be more stretchy for most people because the interest rate is still going to be high, at least in the initial phase. So there will be some hit on property sector as well, right? So these are scenarios that could happen. And last is, let's talk about the stock market, shall we? So in a scenario where the global economy breaks, the first thing will happen is that the stock market will first tank. The Federal Reserve will likely react with a interest rate cuts. And when the interest rate cut happen, then the stock market will likely have a fierce rebound. And so does the bond market as well. The bond market will also shoot up. And this is what we've seen in historically. So let's see whether would that be the scenario that happened. Now, let's see what are the things that we need to do in preparation of that possibility. Now, again, let me say again, I'm not saying that it will happen, but as good investors, and economists, and anybody who put their money into any form of investment, I think it's good to plan for scenarios, right? The more planned and more prepared we are for scenarios, then the more we are ready. So I would quickly accumulate as much cash and dry powder as much as I can and adopt a wait and see approach. And the best part is this wait and see don't need to wait for too long, right? In a matter of days or weeks, we will see how far the Israel-Hamas war in the Middle East, escalates, or maybe it doesn't. Maybe actually Israel and Hamas come to a peace agreement in some form, right? Armistice or something like that. And there'll be some hostage exchange or prisoners exchange or something like that. But at this juncture, I'll just adopt what I call a wait and see approach. For those people who believe in dollar cost averaging, it doesn't harm to dollar cost average less in this scenario right now, okay? And let's see what happened after the whole situation in the Middle East simmer off. There's no need to be gung-ho, okay? There's also no need to panic sell because we don't know what exactly will happen, and if indeed the market will soften. So I think this is probably a nice conservative approach I'll take in planning for all these possible scenarios, and if this were to happen, at least we are prepared, investment-wise and psychologically. Okay, so let me hear your comments. Let me hear your feedback, and I look forward to you meeting you the next time in my next video. Please remember, hit like and subscribe. And I'll see you next time. Thank you and bye bye.